Amazing. Thank you so much, everyone, for being here. And thank you to our panelists. There was a little bit of a quick introduction, but starting from the end over there, again, Alex Thorn, he is the head of research at Galaxy. Then we have Arjun. Arjun is the co-CEO of Kraken and the chairman of Tribe. We have here Cynthia, who is the head of Fidelity Digital Asset Management. And then last but not least, we have Shan, who just got promoted to Chief Business Officer at Coinbase. So a big round of applause for Shan. Very excited. Okay, so the title of the panel is Tokenizing. We're redefining capital markets. And we have some spicy questions. But first, let's start over there, pretty easy, with Alex. So Alex, there's been a really big surge of issuance for the past 12 months or so. Tokenized assets just surpassed for the first time $30 billion of issuance. And so we're going up there. For context, stablecoins are around $300 billion of issuance, just under, so 10x larger. My question for you is, what is driving the growth? Why now?
Regulatory is definitely a big part of it, I would say, right? We obviously have a hugely shifting in our favor regulatory regime. It's only going to get better. I think also, the blockchain technology and the applications built upon them have matured a lot. You also have institutional players that have become more comfortable with it over the years, right? Think about the Fidelities and BlackRocks and, Invescos and all these firms, right? So I would say it's a combination of all three. I would argue too, there is still a latent desire after all of these years to come up with use cases and demonstrate them for public blockchains that are not purely speculative. And I know we're going to talk a lot about that in terms of tokenization, but I think the growth in RWA is also part of that.
Okay, so let's actually, Cynthia, let's talk a little bit about the institutional side right now. So the question is, tokenized treasury specifically, of the 30 billion are about 7 billion. Yeah. And my question for you is, there's actually pretty few holders of them. There's less than 10,000 addresses and really just a handful that actually have a lot of it. And so is the first true TAM institutional cash management, and who's the buyer? Who's buying these on-chain T-bills?
Yeah. So a little bit of what Alex said about regulatory really changing the landscape for institutional demand for tokenized treasuries. So now with the Genius Act in the U.S., which I'm sure everybody's heard a lot about over the last few months, it is the first major crypto legislation in the U.S. authorizing stablecoins. And so stablecoin issuers looking for assistance and outsourcing their reserve management are very much looking for tokenized treasuries. It's part of the ethos of being on chain and getting access to short-term liquidity, yield-generating assets. What that also means on the flip side is that stablecoin holders looking for yield are also really interested and very big buyers. The theme that we saw early in the early buyers of on-chain treasuries is that there's a lot of aggregation and intermediaries that are facilitating more direct retail access to these on-chain products. And so I think as the infrastructure proliferates to more users and institutional users and more of these issuers come on-chain, we are going to continue to see demand and growth. The other big part of the growth and interest from regulated institutions is the collateral use case. And I would say between access to interest and the use of an on-chain collateral instrument that is generating yield and is able to be transacted outside of traditional local business hours is also incredibly interesting and very powerful.
So let's move from institutions and Sean, let's talk a little bit about retail. Is the first killer app for retail bringing liquidity to assets that are highly liquid, like real estate and stuff that is just off-chain? Or is it hyper efficiency from things like stocks that you can already access pretty quickly? Which one is going to be the biggest killer app and the biggest use case?
Yeah, well, I would say the first killer app is obviously stablecoins, actually, which I would qualify as a tokenized asset with $300 billion of supply. But if you exclude stablecoins, the way I think about that is more so where is being on chain 100 or 1,000x better than being off chain. And one of the magic of blockchain technology is you can bring liquidity to illiquid markets. So I actually think that the product market fit is stronger for illiquid asset classes, things like private credit, real estate, et cetera. And I think you see that in some of the data today, where over 50% of the supply actually of tokenized securities, excluding stablecoins, is actually private credit.
Right. And so, Arjun, on the retail side, one of the things that Kraken announced was tokenized stocks.
Yeah.
So stocks are known to be traded pretty easily and be liquid and already accessible by retail. So the question for you is, are tokenized stocks perfect substitutes of traditional stocks, or are they actually just different products altogether?
I thought you were supposed to ask spicy questions, so I'm trying to
I start slow and
Yeah.
then I bring on the spice.
look. I think look, the whole promise of crypto, in my opinion, has always been it's free, it's fair, it's permissionless, it can just move as quickly as possible. You can bring liquidity to assets that typically were not or were illiquid. Meme coins are obviously a good example of that over the last wave. I think like when I think about why we thought about X stocks as an infrastructure that was, again, permissionless, I think everyone forgets about permissionless, and liquidity matters more than any of the other things. And so I get a little worried when people talk about concentration of capital or concentration of assets within a certain few. It's like, why would we perpetuate the system that we already hate in the first place? Like, why do we get into this ecosystem? It's not to dig on Fidelity or anything, but like, it's like they're a manifestation and a perpetuation of something that is for a very select few. And if you're talking about 5 billion, 6 billion, or 7 billion between being underbanked or no banked, that's the way I sort of think about like what the promise of crypto has always been. And so tokenized equities was more about, okay, how do we build out the infrastructure so that anyone can have access to it? So it's not just on Kraken, right? It's on Bybit, it's on a bunch of different chains. We launched on Solana so that it could just proliferate, and made the best products win by enabling the infrastructure. And I think the world you ideally want to be able to live in is, can I trade Doge with Tesla, pairs with stablecoin? Can I use that as collateral for getting a house in, I don't know, Portugal? And
I've always wanted that product.
yeah, and that's not a world we live in yet, but we're getting there faster and faster. And that's
But let's be candid. Right now, the state of tokenized stocks, and I'm not going to use the example of Kraken, I'm going to use the example of Robinhood because we can make fun of them because they're not on stage. It's much easier to make fun of people that aren't on stage. The future of tokenized stock can possibly be to wrap an SPV that owns or may not own OpenAI stock. We can't possibly say.
yeah. I think you're using so let's separate like private illiquidity in private markets from public markets and other instruments that have liquidity. I think it's worthwhile separating. Like, all of these markets have power law. Private markets, which the different hat on it, like we invest as well across all these companies. Like, private is private for a reason. And when you start a company, I don't really want 5,000 people to tell me what to do. It's my fucking company, right? Like, that's kind of how you think about it. And when you start getting into disclosures and public markets, or in some cases what we see in crypto, is that you are more public about like the holdings and what you're doing, or decentralized fashion. I do think it's important to separate those two pieces, which is like, how do you give access to people that haven't had access to private markets? I think that's a completely separate issue.
Okay. So let's get spicy. Alex, the SEC commissioner Hester Pierce, you know what's coming. She recently warned that L2 chains with centralized sequencers controlling transaction ordering that matching rules could qualify as exchanges under the SEC rule. Now, on stage, two of my panelists are running Base in Inc. to L2s that have centralized sequencers. Go.
Well, so we tokenized Galaxy stock, and we did it on Solana. And when you own Galaxy on Solana, you own Galaxy Class A common stock. And I think I respect a lot Arjun's point about bringing access to people. Private vehicles are different. I think, look, we've been very focused on taking that wedged open door that this new SEC made clear existed and just pushing it open for real existing listed U.S. equities. And we were the first NASDAQ listed equity to tokenize its stock. So it's a different project. I think of this as regulatory innovation even more. I mean, the act of tokenization, whether it's even our stock or an SPV, technologically well solved. I mean, how many tokens are there in crypto? Like 100 million? Like, we know how to make tokens, okay? Including ones that are backed by off-chain assets or are off-chain assets. I think when we looked at this, we had questions about two major questions. What form should the tokenized stock take? And what venues or applications should it be allowed to be, platforms or venues should it be issued on or trade on? And we took the view that, well, also because we control our stock as the issuer of our own stock, we can tokenize our own stock, right? I don't think Kraken or Robinhood or anyone has the ability to create a native version of a Tesla stock. Only Tesla can do that. And so but that also means it's not highly scalable. I can't then go and do what we did for Galaxy for Tesla either, right? So we have to what I'm trying to do is create the pathway for issuers to tokenize their real stock. And then to your question, Diogo, about the L2s, I mean, we just had to evaluate where we think it would be most appropriate at this current stage for our shareholders to hold and trade our stock. And I'm of the view that optimistic rollups today on Ethereum are not decentralized enough to avoid registration in the context of securities trades. I know many people disagree with that, and that's okay. I think if that ends up not being the case, then like we would absolutely, like any issuer, want their stock to trade on the most liquid venue, right? So it's not that we're advocating that, L2s aren't good enough. It's just how we did a review ourselves of where we should issue now and thought that L1s were sufficiently decentralized to not need to register. And we don't really want to put it on something that has to register because we're already on a registered exchange. It's called the NASDAQ. So I think that's we're just pushing for the space to be more decentralized when we talk that way.
So Shan, Arjun, Alex Thorn over there says you should be regulated as an exchange.
I think it's fair that L2s aren't decentralized today. They are mostly centralized. We have a path towards decentralization. We're committed towards that path towards decentralization. I think the argument that sequencers or exchanges is kind of bogus. Like, it doesn't make any sense to me because a sequencer fundamentally is just infrastructure that collects batches and orders arbitrary transactions. There's no discretion involved. There's no matching necessarily. There are priority fees that inform the ordering, but it's effectively an algorithm. So I just think about it as sort of similar to like AWS. It's just infrastructure that powers transactions that are flowing to the blockchain, which I think is just fundamentally different than an exchange, which is matching buyers and sellers.
I mean, I hear that argument, but to me, it's like it's still run by one company. How do we know that's how the algorithm functions, right? If it's run by many, right, whether it isn't how it functions or not, there's still no party to regulate, and that's why it like fundamentally is impractical to regulate. And my goal is to make these decentralized systems impossible to regulate. That's what makes them decentralized. And so, I mean, that's where my questions come from. Like, what assurance do we have that the sequencer is only using an algorithm that does this, right? And I'm not aware of one. I don't think that they're not. I don't think that, they're abusing their users. I think, in fact, you could make the case that pragmatically today, when we look at the sequencers, they're probably getting better execution for their users even than many of the decentralized L1s. It's a question of like, how do we know as the issuer?
They don't do, but they can. And so part of that
that's my thought. I may be wrong about that, but I mean, this is what we thought about when we chose Solana.
Feel good?
So we took the approach with Inc. That Kraken would contribute to multiple foundations, not just the first L1 or L2. And so that's the way we think about it. And then the goal has been always that we would contribute to a foundation. We wouldn't want to own the layer 1, layer 2. I actually think it's quite dangerous for centralized companies to own that layer versus the community. And the whole point, again, of this movement is, how do you empower the customer? How do you empower the community? And how do you empower decentralization so that you can, open source, fork, and innovate? And Inc. is not ours. I mean, we have a lot of sway into what we want, but when I take a look at that team, I mean, they're arguing against this all the time. Frankly, it's quite frustrating, but it was set up that way from day one so that they can push back and say, you know what, like, hey, we don't want to go exactly the way in which Kraken wants to, which basically also means that we'll, as Kraken as a company, means we'll take multiple shots on goal, and we'll work not just with ours, but with other chains And again, when we provide and build infrastructure, again, XDocs isn't on ink yet, right? It's a choice the foundation has made not to support it yet. They will, but we've worked with Solana, BNB, Tron. There's just a list of folks that we're working with, which is fine, and that's the point.
Cynthia, it's your turn. Tokenization has one of the core principles as disintermediation of the current intermediaries. Fidelity is kind of one of the big intermediaries right now. So is your move into tokenization an admission that open and decentralized is a better path than the current path that Fidelity is on?
So a couple of things about intermediaries, because I'm looking across, the platform here, and everybody is an intermediary, right? The reality of this core thesis around decentralization and control isn't about eliminate all the intermediaries, because nobody lives in a hermetically sealed bubble that's self-sustaining, but rather this is about simplifying the existing construct of how it is that investors get access to capital, that investors get access to investment opportunities. So when I look at the way in which Fidelity has constructed its platform over the years, the primary ethos from our standpoint is we're here to serve our investors. And we're here to give our investors choice. We're here to give our investors access to a range of investments. And those investments take the form of direct investment in self-directed brokerage. You can buy securities. You can buy funds. You can buy everybody's funds. We have an open platform from which we offer investors a wide range of choices and broad level of education to help those investors make those choices. So the idea of tokenization aligns with that ethos of choice and access to investors, access now to on-chain investors to get access to Fidelity's investment platform, and also the ability, as we think a lot about this integration of traditional markets and on-chain markets, is about opening up the free flow of capital between on-chain markets and off-chain markets.
And speaking of that, I guess the question now is, what is stopping us? And so, Alex, would love to start by saying, or by asking you, one of the biggest advantages of tokenizing anything, and stated, I think all of us would agree here, is the fact that you get to inherit this very robust set of building blocks that DeFi has for us. We've built so much infrastructure. It is so cool. It's just begging to be used.
Yeah.
However, right now, you cannot use tokenized Galaxy stock by Superstate, by the way, portfolio company, super cool. You cannot use them to actually use DeFi because it is a security, and these things are just not. Is there a path forward, is my question, for a security to trade on DeFi?
I think there is. In fact, I think earlier today, maybe it was yesterday Eastern time, the information reported that the SEC is looking very strongly at an exemption to allow stocks to trade in DeFi very soon. We already kind of know this, right? That's part of all the companies on the stage have been meeting with the SEC. If you go and look at the Crypto Task Force website, you'll definitely see all of us have been meeting with them. We know that's the direction it's going. So I think they will actually give a pathway. It may be time limited or volume limited to start. And then I think you'll see a lot of interesting stuff emerge. I mean, that's what we all hope. Like, again, which regardless of venue, like, you're totally right. The DeFi building blocks have proven themselves, especially the core of like trading and lending on chain. Like, that's been around a long time. We've put a lot of volume through these apps. And I think you'll see some really exciting things emerge. I think I'm of the view that intangible assets are extremely ripe for tokenization more than, say, real estate or, physical collectibles, just because you don't face that provenance problem. So I'm looking for things like securities, whether equities or fixed income, possibly like intellectual property or even like legal contracts of some kind. And I think you're going to get from this SEC clarity. I actually think this is probably the top priority of this innovation exemption that the SEC has been talking about. But then also, we all got to go and tell, if you want to do it the way we're doing it, like, you got to go and tell all the issuers how to do it and that they should do it. And I think the arguments in favor are instant transparent settlement, in DeFi transparent liquidity, like maybe, like an AMM like Uniswap is going to have worse slippage than like the top of the book on NASDAQ, but you're going to know exactly what that slippage is, right? It's always on, right? Not only 24/7, but programmable. Like, We just haven't been able to try yet. And I think once we are able, and I think it's coming, you'll see a revolution in equity trading. And the SEC is going to have to probably write a bunch of other new rules because they don't really contemplate most of this. But I think it's coming. That's been the barriers regulatory.
And then, Shan, I would love your point of view. So from the vantage point of overseeing Coinbase Ventures, you guys have done thousands of investments at this point, probably. What is left to be built? What is stopping us, and what is left to be built in the market of tokenization?
Yeah, I mean, Alex touched on the regulatory piece. That's like the biggest thing that's out there. I think, Arjun was talking about wrapped assets. Alex, obviously, they took the approach of a more native version. There's a wide spectrum of basically like a synthetic asset that gives you exposure. You mentioned the Robinhood approach, like the canonical security that could be tokenized on chain. And I do think that there's ultimately going to need to be some type of cross-asset, cross-chain liquidity layer that aggregates liquidity and allows for interoperability between these things. That creates a lot of opportunity also. Like if you think about the superstate approach where there's fungibility between the tokenized security and the exchange traded security, then there's a lot of arbitrage opportunities between the off-chain world and the on-chain world until there's sufficient liquidity on chain. So I think that's one bucket, that cross-asset, cross-chain liquidity. The second, we'll see how this works out with the regulations, but I think a lot of compliance infrastructure is going to need to get built for, how do you actually do permissioned monitoring for which wallets can actually, you can transfer these assets to, who's actually engaging in these securities. I think I'm relatively skeptical that they'll be sort of like free floating and in the wild. That would be amazing. That is like the dream, but I don't think that we'll jump there, at least from the onset.
Yeah,
that's what I want.
So that was a bridge too far for us to try. We would never argue that these should be like anonymous bearer assets. Maybe they should be. I think it would be great if they were.
Yeah.
But that's a whole nother ball game. To your
But wait, do we not agree, all of us on the panel, that is the only ultimate goal for this, and anything other than that is absolute abject failure?
as an issuer, you need to know
why would you say that?
Yeah.
Just because it feels to me, and again, I'm not one of the panelists, but it feels to me that we have built such amazing building blocks and tools, and if we don't get to use traditional finance with all these amazing tools, we kind of fail at the actual promise that we are supposed to deliver for all the assets in the world, which, by the way, sit on the TradFi side of the world, not on the DeFi side of the world.
No, I don't know. I mean, you take a look at crypto and what's happened, like let's take a look at Dogecoin, or take a look at any of the, the BTC ordinals that just started now, or take a look at ETH. All this stuff that's happened on the edges, and then there was liquidity, and then there wasn't any friction, right? So like this whole concept of permissionless, we keep talking about stuff like, hey, maybe I have an issue with it. Like, let's just perpetuate the system that's fucked, and let's bring it on chain. It just doesn't make any sense to me. So if there's a expression of how people feel in like a certain country and they want to tokenize it, that's great. If they want to do it for their government, if they want to do it for their assets, illiquid or not, like that's the whole point. And so I kind of don't really care about the company going public and saying, how do I get access to leverage my brand and extract value? Care more about how do you bring value to the 7 billion people that are out there with our tech, and then figure out what are the financial products that are going to be built. What is the thing that matters the most? It's access to capital. What do you do with it? What is your collateral? Can I get forward mobility? Like those are the things that matter first. Then you can think about the next layers. And I think we kind of get lost in translation, which is, hey, US has had this robust, capital markets and liquidity, and so let's just copy it. No, there's parts of it that don't make any sense. I think our banks are fragile. I think rehypothecating people's funds and having like 9x leverage is stupid.
But you feel like we're copying the system and not just bringing the assets over one at a time? But
you bring in the assets that matter for the people, right? And so this tokenized equities matter. Yeah, there's a certain amount of intrinsic value, and then we're going to be able to trade off of that, lend off of that. Great. Can you do that with other assets? Can you pair them together, bring liquidity because it's global liquidity? Yeah, let's do that. But there's just like again, I apologize for Fidelity stuff, but like, look, Fidelity, most of the products are for rich people, and they don't get access to that if you're sitting in Argentina, selling pairs.
Well,
It
those are
you
two
just don't
different
get it.
things, right? There are retail investors who get access to investments on the Fidelity platform.
But
then
if you're sitting in Argentina, you don't have access to Fidelity.
well, and
But
then
if you want to get
regulatory issue.
if you want to get access to corporate yields,
Yeah.
you have to have $500,000 or $1 million in your bank account.
Well,
don't
but
get
if you're in Argentina, you can't
In
access
the United
Coinbase
States in the first
platform.
place.
That's the problem, right?
I think my point being is that how do you reduce the friction for what rich people get to everybody? And that's the whole point of why we're here.
That's amazing. I mean, I hope that we bring all of the assets to DeFi, and then the last person out of TradFi turns off the lights. That is the hope, right?
Or that we move the system onto a more efficient system for the allocation of capital and access to investments. And I get totally what you're saying about countries outside of the U.S. or other developed countries where access to banking and access to capital is almost non-existent. And so this is where crypto has been able to provide access, right, to payment systems and access to banking services. And so as that, right, will continue to proliferate, and the rest of the world will see that this is a system that offers better opportunities for allocating capital, more transparency, and definitely more efficient than what we've seen.
People are voting with their dollars, right? There's the reason why worldwide, people go towards stablecoins, right? It's a safer asset. On our X stocks, like I look at it every morning because it's so humbling. And that like our top stocks is like Tesla, S&P 500, and McDonald's. All right, it just means that there's a lot of things that people care about outside the United States that they want to have access to, and then they want to do something with it.
Cars, big companies, and fast food.
Yeah.
That's amazing. Awesome. Okay, so now let's go into a quick fire round real quick. Have to be quick. And I'm going to start with Shan in order, every single one of you. So the first quick fire round question is, outside of your own company, you can't cheat, which project or protocol is doing the most interesting work in tokenization right now? Shan.
I would say a company called Veda, that's a vault infrastructure provider. So they allow asset managers to sort of design and curate different yield strategies that you can deploy on chain. And I think that infrastructure gets really interesting once you have more types of tokenized assets that are on chain, because you can create n permutations of differentiated bundles.
Gotcha. Cynthia?
I'm going to cheat a little bit. I'm going to talk about on-chain ID because that is the real way to unlock liquidity across all of the different trading platforms and across all different protocols. We're spending a lot of time looking at projects developing on-chain ID solutions.
Arjun?
I really don't like banks worldwide. And so
I started a bank, right?
Yeah.
Okay, just making sure.
I have two, but I don't like them. And and so when I think about, again, insurance, mortgage-backed securities, the full gamut, it's like, how do you bring, again, all that access to people? And so there's a few protocols that have already started that. Re protocol is one on the insurance side, but it's, again,
What are their names?
Re protocol is one of them that we're sort of backed on the tribe side. And any project that is along those lines where I spend more of my time and deploy capital.
Alex?
You guys talked about Superstate. We're also they're also a portfolio company of Galaxies. I just like what they have done. I was looking for the fastest, real, scalable way to do this, and they were the fastest. They have great technology. I also just love the fact that with stablecoins also, that you can, stablecoins are the first time you can self-custody actual digital dollars, and I think with tokenized equities also, like self-custody for equities is a very, very interesting thing that's really not possible since the physical bearer certificate. That's just every wallet, actually. That's not, you don't need a new wallet for that. But
Okay, we're out of time, but one quick question, and it's binary choice here, which is, in 5 years, will the most AUM for tokenized assets be on a public permission network like Ethereum or on a private permission ledger run by consortium of banks or a bunch of corporate companies?
God, I hope not on a permission network. So yeah, a public permissionless network, sure.
Cynthia?
Public.
Permissionless.
public and permissionless.
Full agreement. Thank you, everybody, for your time. Let's thank the panelists.